Hi, everyone. Welcome to the webinar today. We have two very special guests, and specifically for you all in the New England area, this is one of the first times that we've done a webinar specifically for you guys, and I'm really glad that we have Sean and Patty with us today. We're going to talk about some really important strategies that really all investors should know about, and you may have heard of 1031s, DSTs. We still haven't covered opportunity zones here at AAOA, so this is going to be some new content for you. And I think what's most important here is that we have two experts that really know your area, and that's going to be Sean Whalen from Asset Strategy and also Patty Flowers from IPX 1031. She's a qualified intermediary, and I think this is going to really provide us a new perspective that we haven't had before. So for those of you on the call, again, thank you for joining. And then if for some reason you can't make it to the end, we are going to be sending you the recording tomorrow, so don't worry. We'll also be sending you over the PowerPoint slides, and Sean mentioned he has a great handout, which he'll be talking about later. So definitely stick around, because if you can, we're going to be having some questions at the end, and Sean and Patty are going to be the best people to answer them. So I'd love for you to stick around for that. And then if you have questions, you can put it in the question box. Don't put it in the chat. It makes it easier for me to take a look at those. And with that being said, Sean and Patty, thank you so much for being on the call today. I'll let you guys take it away.
Hey, thank you, Alexandra. We really appreciate it. And we appreciate everybody joining us today. So as you know, the title of our presentation is just really some capital gain strategies for investment property owners. We're really trying to help educate owners on all their available options when they do decide to sell. So with that being said, we're kind of going to go into the introductions of Patty and myself. Then Patty will go over the 1031 exchange rules. I'll go over and touch upon Delaware statutory trust. I'll explain what those are in a minute. And then I'll touch upon opportunity zones as well. And then we'll open it up for Q&A. So like Alexandra said, please feel free to type your question in the box, and we'll get to it at the end of the presentation. So Patty, we're lucky enough to have Patty. Patty's one of the best QIs in the greater Boston, New England area. She's been at IPX 1031 for over 20 years now. IPX is part of a full service, they're a full service QI, but they're also part of Fidelity National Financial, which is a publicly traded Fortune 500 company. So we're lucky today to have Patty, and she'll be able to really get into all the details you need for 1031 exchanges. I'm, as Alexandra mentioned, Sean Whalen, Director of Business Development and Asset Strategy. I'm CFP. Asset Strategy Advisors, we're a wealth management firm. So what we do here is help people from a consultative approach. A lot of our clients have, investments in, stock market, bonds, but also real estate. So we like to kind of give them some ideas of what capital gain strategies are available to them. A lot of advisors might just ignore that part of their portfolio, and that's such a big and critical part of the financial plan and estate plan, and also tax planning purposes, that we come and just really just educate them on their options. So that's our intent for today, is to really just educate everybody on their options of what's out there. So with that being said, I'm going to pass it to Patty. I'll stop sharing here my screen, and then Patty, if you want to upload your screen, you should be able to now share your screen at the bottom.
Sure. Very good. Well, thank you so much for having me today. And as Sean mentioned, I'm part of a company, IPX 1031 Exchange. We're a national qualified intermediary. I'm part of the Northeast region and have been doing exchanges for many years now. It's a great option for property owners, investors, and also for advisors to try to help their clients with the 1031 exchange and just be able to save on the capital gains tax, roll your investments to other options that you might not have had if you were just working on your own. So we'll just slide down here. So the 1031 code. So in section 1031, which is part of the IRS code, they talk about investment property. So it's not your primary residence, and it's not a straight vacation home. But any type of real estate that you have, that you hold for investment purposes, for your business, for rental, for leasing, any of that, when you go to sell that property, normally you have a capital gains tax to pay. But if you set your sale up as a 1031 exchange and follow all the rules in the middle, which we are here to help you with, you can actually go on and do a 1031 exchange, and so that the taxes are 100% deferred. So really what you're trying to do is watch to be sure that there's no gain or loss when you sell. So whatever your basis was originally in the property, now when you go to sell that property, that's how you calculate your gain. And you may have improvements or not added to that. When you go to sell that property, normally you would have the gain to pay. But if you set it up as an exchange, you're able to get up to 100% of that tax deferred. So what are you deferring exactly here? So the federal capital gains tax is either 15 or 20%, just depending on your income, single or married. The 2013 healthcare tax, if your net investment income on the specific year that you sell is greater than a certain amount, you owe an additional 3.8 tax. The gain due to depreciation, sometimes they refer to this as the depreciation recapture tax. So whatever you've taken in depreciation over the years, normal wear and tear on the property, that's a great thing in the year that you take the depreciation. When you go to sell that property, the IRS wants some of that back. So that depreciation amount is actually taxed at 25%. And then the rest of the gain would be taxed at that 15 or 20 federally. From a state perspective, the state capital gains tax vary across the country. The lowest is usually around 5% and is high up in California is over 13%. But in the Northeast, it really ranges from about 5 to 9% for the most part. Pennsylvania is the only state that does not recognize the 1031 exchange on a state level. So you can defer the federal capital gains tax, but in the Northeast, Pennsylvania does not allow the state tax deferral. But in any regards, whether you get to take advantage of all 4 of these deferrals or not, the goal is that the money that you would have had to pay at the sale, pay to the government in taxes, it's just gone. But instead, you get to keep that $30,000, $50,000, $80,000, whatever it is that you would have paid in taxes, you get to keep that money working for you and roll it on into new real estate. So you're doing a 1031 exchange to go on and buy other investment real estate, and that money that you saved from the taxes is more equity that you can roll into other real estate. So it's a great 1031 advantage. Apologize, the cursor's a little bit slow here. So this is, again, just a map from a state perspective. As I mentioned, California over in the far west there is over 13%. It changes every year, the capital gains tax rates, but you can just take a look at this and get a good feeling for what state you're in and what you might be paying. In New Hampshire, they don't have a state capital gains tax, but they do have what they call business profits tax. So you got to be a little bit careful there as well. Obviously, nobody wants to pay the taxes. That's the #1 reason why you do a 1031 exchange, but there are plenty of other reasons. One might be your cash flow. You have a piece of raw land, either you bought it thinking you were going to do something with it, or it was inherited, whatever the case may be. It's sitting there, you're paying the real estate taxes on it, not doing you much good, and you decide to sell it. You can actually sell raw land and buy an improved property that you're going to immediately start to get income from. And that's a great 1031 exchange. Depreciation. Some clients will have property that's fully depreciated or pretty close. They've owned it for a number of years and they're looking down the road in the next year or two and realizing they're not going to be able to get the write-offs that they used to. So in that scenario, you might do a 1031 exchange and go on and buy property of greater value. When you do that, you open up a new window of real estate that you can start taking write-offs on. Appreciation. you might move from town to town or state to state or all the way across the country. So you can take a property that's pretty high in appreciation, sell that to make a great profit, do a 1031 exchange, and take those funds and go into 2 or 3 different replacement properties in areas that are better buy right now. So again, you might wind up buying something that's closer to the train or closer to the water, or closer to the city. You might get better rents. Your property might need some work and improvements made on it, but instead of doing all that, you might just decide to sell it and buy something that's already a little bit nicer and getting those higher rents. So there's really a lot of different choices that you have with that. Conversion, down in the bottom left. In certain cases, people use this as a retirement plan. They may take some of their 1031 proceeds and buy a single family rental or a condominium somewhere. So it's certainly going to be a rental for at least 2 years, if not longer. But after that, they might decide to convert it, quote unquote, to their primary residence or their retirement home. And you can certainly do that. Right now, as long as you're renting something for at least a couple of years, you can change your mind later on and convert its use from rental and investment use to personal. Joint ownership. You might own property with other people and you've been getting along fine, but you decide you want to go your separate ways with the funds. So there's a couple different strategies for that, but if you're on title as tenants in common with another person or another entity and you each file separately every year for your percentage, you can actually sell the property, take your proceeds, and go your separate ways without any issue. So it's a nice way to move your investment. Those of you who are in partnerships or multiple member LLCs, they have some different objectives that they have to get through before they can sell. So if you're involved in a partnership or a multiple member LLC, thinking of selling, it's better to plan ahead and try and understand what the options are, because you really, unless that partnership or LLC is going to stay together, you might have to do some work ahead of time. Reduce management burdens. So this is another great option on the replacement side. Sean's going to talk about this in detail, but I have a lot of clients who will sell property and they're just a little bit tired of dealing with all the tenants and all the work involved and the day-to-day responsibilities. They don't want to pay the taxes, but they don't want to manage property anymore. So you can actually do a 1031 exchange from something local and go into one of the DST, Delaware Statutory Trust programs, where you're still going to get all the benefits of a 1031, but you're going to have all the hands-off of the day-to-day responsibilities. And Sean will talk about that a lot in the next half hour. Another estate planning rule for 1031 down in the bottom right is a lot of times you'll see clients will have a couple of properties, 1 or 2 or 3 properties, maybe more even, and they want to be able to leave some money for their children or help pay for their grandkids' college education. Well, if you turned around and sold one of your properties, as I mentioned earlier, you'd owe about 28, 30% in taxes right off the bat, and then only have the remaining funds left over. But if you do it as an exchange, you can actually keep continuing on. You buy replacement property, that basis is following you on paper. You're still building equity as you go through the exchanges. Maybe sometime in the middle you decide, hey, I think I'm going to refinance, pull some of that equity out. You can do that without paying the capital gains tax. But you're continuing on, excuse me, with the exchange. When you pass, your heirs get the stepped up basis, which means that that bottom line starting point from the beginning rolls up to the value of the properties you own as part of the exchange and passes to your heirs capital gains tax-free. That's a huge estate planning perspective that a lot of clients enjoy. Properties can also be part of your profession. If you have a business, a restaurant, manufacturing plant, you're a professional medical doctor, dentist, what have you, you can have your practice or have your business running in real estate property that you own. So really there's a lot of options in 1031, a lot of reasons why someone might want to do it. You just have to find what's right for you and think about it in terms of what you do on a day-to-day basis. As I mentioned, like-kind properties, so it's very, very flexible. That term like-kind really shouldn't be there, I don't think. Of course, the IRS doesn't ask me my opinion, but really you can do anything as a 1031 exchange as long as it's real estate that's investment or business use. So you could sell retail, buy apartment buildings, sell multifamilies, buy land, even leases. If you have a lease with at least 30 years remaining, including renewal options, that can be part of a 1031 exchange, and you can go on and get another 30-year plus lease, or you could buy something fee simple. You can go into the tenant in common and the DST, the hands-off replacement properties. Those are all like-kind to something that you might sell local. So it's very, very flexible as long as it's real estate and held for use in a business or investment, which might mean rental, then it counts for 1031. So why am I involved? So IPX is what they call a qualified intermediary. We're the neutral third party that the IRS says that you need to structure your 1031 exchange. Your attorney, your CPA, your real estate broker, your advisor, none of those people can act as your qualified intermediary because they actually already perform services for you. They are considered related to you by business. So they cannot be your 1031 person. You need a neutral third party. What we do is we actually do a lot of this, obviously education, but when you're getting ready to sell a property, we step in and get a copy of your sales agreement, your purchase and sale agreement, and we assign into that. So we act as a principal between you and the sale, and then you again on the other side on your purchase. We prepare all the documentation that's required. We assign in. We open an exchange account at a financial institution, at a bank. It's similar to an escrow, but has a little bit of a different feature to it. So if that sale closes, the proceeds after you've paid off your real estate commission, recording fees, deed stamps, etc., everything's paid off as normal, but that sale proceeds, if it goes back to you as the seller, that's actual receipt of funds, and you have to pay the tax if you receive the cash. If it goes to any of your advisors, that's constructive receipt of funds. The IRS deems that the same as if you receive the cash yourself, and there's no 1031. So instead, the proceeds at sale closing get wired directly to IPX for your exchange account, and the money sits there. And then when you're ready to go on and buy the replacement property, we do some paperwork with you, and we wire those funds right into the purchase closing. So we're really a principal in place just for your proceeds to manage the benefits of the exchange, which is the cash, to move it from the sale through to the purchase. All the while, you know, the funds are protected. Our company specifically, we open up a separate exchange account for every single taxpayer we have in the country. We never commingle the funds. Your funds are there under your name, your seller name, and your tax ID number, or your EIN number, and it sits there safely waiting for you to go on and do the purchase. So in the 1031 exchange, a lot of the rules are there for your guidance, but the IRS really wants to be sure that you understand that when you do a 1031 exchange, to be 100% tax deferred and owe no taxes at tax time, your goal is to, number one, buy new property of equal or greater value than the net sale price of what you're selling, your sale price minus your closing costs. Number two, reinvest all of the sale proceeds. So as I mentioned, the proceeds get wired to your exchange account after the sale closes, and your plan should be to use all that cash on into the purchase of the replacement property. Number three, replace the value of the debt. So a lot of people have a big misconception that they only need to roll over their cash to a purchase, and they only need to buy for that amount, or they only need to buy for their gain. And both of those theories are incorrect. To be 100% deferred, not only do you have to roll all the cash through to the purchase, but you also have to replace the debt. So whatever mortgage you paid off, any financing that you had on the property that you sold, that amount gets paid at the sale closing as normal. but you do have to go on and purchase replacement property that's equal or greater value, use all the cash, and then match that debt on the buying side, either with new financing or new cash. So we'll go through an example in just a minute, but the goal is to have equal or greater value, equal or greater debt, and roll all the cash. As long as you do that and receive no funds at the sale or purchase, it's 100% tax deferred, which is usually the goal. So here's a great example. The relinquished property is the one that's being sold, and the replacement property is the new one that you're going on to buy. So in this example, easy math, round numbers, everything works perfectly. And I know that normally, you'd have some closing costs in here, which I didn't list them all. But for example's sake, you're selling for $750. You pay off a mortgage of $200,000, which is normally not a round number. You'll pay some closing costs, but again, we'll just pretend that you're getting $550 at the sale closing. That $550 gets wired to your exchange account. And now on the replacement side, you found something for $825. So you're going up in value from $750 to $825. You're going to roll the whole $550 from the exchange account into the new purchase. And then you're going to get financing for the difference, in this case, $275. Equal or greater value, equal or greater debt, and you rolled all the cash, no taxes are due. That's really how you want to look at it. And of course, as I said, you could say instead of getting a mortgage for $275, you might say, hey, you know what? I have all that cash somewhere, I'm going to roll it in. Or you might say, oh, I had $75,000, so I'm just going to get a new mortgage for $200 and add in $75 cash. So you can kind of mix and match to replace that financing. In the exchange, the one other thing I just wanted to point out is that sometimes people do want to keep cash at closing. So say when you close on the sale, $550 is your remaining proceeds, but you say, well, wait a minute, I want to keep $50,000 to buy a new car or take a great vacation or something. So you can keep cash at the sale closing. So if you say, I'm going to keep $50,000 and I'm only going to send $500 onto the purchase, that $50,000 cash you keep is what they call boot. So the capital gains tax will be calculated on the $50,000, so you'll owe some tax, and then the rest of the gain will be deferred. So that's a partial exchange. If you decide to keep some cash at closing and only roll over a percentage of the proceeds, that's okay, but just keep in mind you'll owe some taxes on the difference. So the timelines, huge topic of conversation in 1031. So what I try to remind clients in the first conversation is that you have a very short window to look for replacement property. So day 0 is the sale closing date. That's the date that the benefits and burdens are transferred. From that date, you only have the first 45 calendar days to identify to us with a form. We have paperwork for everything. Identify to us in writing what property or properties you plan to purchase. You have 6 months to close, 180 days, and even on the commercial side, that's usually doable even with all your due diligence and city and town permitting and what have you. But the 45 days is difficult. So even before your sale closes, I try to ask people, what are you planning to buy as replacement property? You should really be thinking about it. What are your choices? Where are you going to look? Because you can be looking and trying to make offers on new property while you're waiting for your sale to close. That way, you're minimizing the problems that you might have in the 45 days finding something, because that is pretty quick. There are generally no extensions in 1031. These are the timelines. Even if the seller backs out, if something happens to the property, there's generally no extensions and no excuses. The IRS sticks to these timelines. The only thing that's happened recently, as we all know, is the pandemic of the last few months has really inhibited real estate. And so along with other tax code items, the 1031 exchanges did receive an extension on their deadlines. The problem is that normally we get a 120-day extension in 1031. If there was a hurricane or a tornado, wildfires, flooding, anytime that something's declared a presidential disaster area in a certain part of the country, usually county by county, the president will declare it a disaster, and then the IRS will step in, and 1031 clients who have properties in that area or live in that area that's declared a disaster could get a 120-day extension. In this case, that was not what the IRS gave. Instead, they said that anyone who has a 45-day or 180-day deadline that falls here between April 1st and July 14th, you get an extension to July 15th. Well, if your timelines happen to fall in April or early May, that could have been a good deal for you because now you get extensions to July 15th. But anyone who's selling now in June and going forward has no extensions that they can take advantage of. So the extensions are effectively over for most people unless you already had a 1031 exchange in process. So you really have to be careful. We have been working to try to get another extension for 1031 and explain the situation, especially in the Northeast where everything has not opened up, lenders are behind, still difficult to get some due diligence done. But as of now, you should know that if you're selling property in June or July or going forward, as of right now, there are no more extensions. You can always check back with us later to see if that has happened. If you have an extension in process, your intermediary should have already given you the notice to go to July 15th. So you can identify properties a couple different ways. The 3 property rule is the most common. You can identify up to 3 properties of any value. If you want to identify 4 or more properties, you do have to follow this 200% rule, which is a little bit trickier. So the 200% rule works best if you're identifying one larger property. I'm sorry, if you're selling one larger property and identifying 2 or 3 smaller properties. And even with the DST replacement property programs, a lot of times the 200% rule is what they have to use to identify. The 95% exception is not used too often. I think it's just a fallback for people, but mostly it's the 3 property rule or the 200% rule that you would follow. So the benefits of the 1031 exchange, obviously 100% tax deferral. If you want to keep some of the money, some people think it's a benefit to do both. Do a 1031 exchange and get some cash, so just paying a little bit of tax. And in 1031, there's a very specific process that you follow. The rules are there to help. So even though some of them are a little tricky, our goal as the intermediary is to make sure you understand and follow all the rules. You'll get the stepped up basis. The real estate has a secondary market, so you can sell and buy. We'll talk about some of the other options as Sean goes into the opportunity zones and the DST replacement properties. So I think we'll take it from here, and we're going to do some questions and answers at the end. So I'm going to let Sean take over and share the screen.
Thanks, Patty. So, you know, this decision tree, we created a little decision tree because it's obviously a big decision from any investment property owner to decide to sell. So once they decide to sell, there's kind of 2 paths they can go. They can pay taxes, as Patty mentioned. There's the federal, state, and that depreciation recapture 25% is really kind of a gotcha tax that a lot of people are not aware of, and then the net investment and income tax. So taxes can add up really fast. So if you do decide to do that path of a 1031 like-kind exchange and you hire somebody like Patty as a QI, there's actually 2 more kind of paths that somebody can go on. They can either continue to be that active landlord dealing with tenants and trash and termites, all the fun, terrible T's, property management, all that fun stuff, or they can be more of a passive landlord. And that's what we're kind of going to go into a little bit here about Delaware Statutory Trust. So Delaware Statutory Trust is really just an ownership structure that was approved by the IRS in 2004 as a way to complete a 1031 exchange. So a large institutional sponsor will buy, let's say, a 400-unit multifamily property in Texas, and then they'll sell fractional shares of the trust to individual investors that are contemplating or in the middle of a 1031 exchange. And that's how the 1031 gets completed. So Some of the different types of property types in a DST, are multifamily, healthcare, self-storage, retail, student housing, industrial, and office. So there's a lot of variety. It depends on the timing of your exchange, what's available, but there's just really some interesting asset classes that a lot of people are, unaware of that a DST contains. So basically, these types of products, and I'll go into opportunity zones as well, but opportunity zones and DSTs are what are considered by the SEC to be Reg D investments. So you need to have a net worth of $1 million or more, and that does not include your primary residence, or you need to have $200,000 of income or as an individual, or $300,000 as a joint for the last 2 years to qualify. Some of the potential benefits of a DST, Patty mentioned some of these, but obviously you continue to get all the benefits of the 1031. So there's tax deferral. Tax forgiveness is exactly what Patty mentioned. You get that step up in basis if an owner continues to do a 1031 path, that when the owner does pass away, their heirs do get that step up in basis. Acquire higher quality investment grade replacement property. So you're able to get institutional type replacement properties. Like I mentioned, that 400 unit multifamily in Texas versus, being forced into a limited replacement options in, across the street, in town, in your region. There's ways to kind of go about it in a different way. Diversification, your minimums are around 100,000 for DSTs. So you're able to, if you have a $500,000 exchange, you're able to do up to 5 different properties throughout the country versus maybe just one property locally. There's liability protection, obviously potential for monthly income. Most of them are around 5% on an annual basis. Just for the income side of it. So that's usually paid out on a monthly basis. There's 1 or 2 maybe quarterly, but for the most part, it's a monthly basis. And then debt replacement, as Patty mentioned, you need that for your 1031 exchange. Most of these are in the 50% loan to value range. So there's the ability to replace the debt component of it as well. And here's just a quick example. Just to kind of give you a ballpark of how it looks like from a net basis, but sales proceeds on a multifamily or investment property, $1 million, no mortgage. You see the net sales of $1 million. The original cost was 100. The adjusted cost was 0. The capital gain off the adjusted is $1 million. So you can see this only had $100,000 of depreciation, which, is a little more sometimes than a little less than what we usually see, but 25,000. The Fed tax, state tax, that 6.1 is just the national average, 6.1%, and then the Medicare, that 3.8 investment income tax. So you're out almost $300,000 based off of your sales. So that's why it's so powerful, the 1031 exchange. One of the last IRS rules out there that really helps from a capital gains standpoint. So in closing on the DST side, we have a little, kind of top 10 reasons why 1031s and DSTs could be helpful for investment real estate owners. If anybody has an interest, feel free to just text. We have a text back technology here at the firm. So just text text top 10 REO, real estate owners, top 10 REO to the text number is 44222. So again, you'll see this in the replay, and obviously feel free to ask those questions at the end. But that's the general overview of how Delaware statutory trusts work and how it can help clients who are tired of being landlords but don't want to pay the taxes from selling. So that's why they work really well together with the 1031 exchange. Like any investment in real estate, there are risks in DST as well. Tax laws on 1031 could change. There's a lack of liquidity. We can go through all the details. There's a lot of, each sponsor has kind of a private placement memorandum that lists all the pros and cons of DST. So we can certainly go into it. And just one last point, as I stated in the beginning, we come from this as a consultative approach. So, there's many cases where we tell clients that, DST is just not worth it for them, or an opportunity zone, whatever the case may be. So we'd like to just have a high level conversation, hear your particular situation, and then kind of give you some suggestions on exactly what the best approach from our perspective is. So opportunity zones, as Patty mentioned, DSTs and 1031s for our investment property owners is kind of what we usually lead in, because it's a stabilized asset, gives you income, helps you defer all taxes. But in cases where somebody fails to get a QI involved, or their investment property, their replacement property falls apart last minute, there is another avenue. It's called opportunity zones and qualified opportunity zone funds, and I'll go into a little detail here. So basically, the concept was championed by Sean Parker. He was the founder of Napster and the first president of Facebook. So, early on, probably in 2016, 2017, he was saying, I have all these capital gains in Facebook and other assets. Instead of just paying the government taxes, it would be great to get some tax incentives, some tax breaks, but also help lower income areas throughout the country. So we kind of teamed up with Senator Cory Booker, a Democrat out of New Jersey, as well as Senator Scott, a Republican out of South Carolina. And it got into the Tax Cuts and Jobs Act of 2017. And it's officially known as opportunity zones. So basically it's connecting people with capital gains with low income areas throughout the country. And as you can see in the next slide, there's over 8,700 tracts throughout the country. If you go to EIG.org, this is Sean Parker's kind of think tank group, but if you go to EIG.org/opportunity zones, you can type in any address, throughout the country, and it'll, kind of zoom in this kind of rust color if it's considered an opportunity zone or not. So it's kind of interesting to see what zones are out there. This is all based on 2010 census information. So a lot of these areas, there's some areas in, outside Phoenix, Arizona, some in Napa Valley, some in Newport, Rhode Island, some really, what most people think higher end areas. And, it's because a lot of these areas around them have gentrified because the data was based off of 2010 census information, and that's what they had to use. So each governor kind of designated the tracts in their own state. So it's kind of interesting if you want to go to that website. It's a really interesting kind of site to look at. So there's three major components. It's got a similar type time frame, 180 days. But the difference with opportunity zone funds, it can be for any asset. So you could sell real estate if you missed a 1031 exchange, if you sold your business, if you sold some stocks that had a huge gain, if you sold some bonds, if you sold some stock options, antique coins, art collection, whatever it is, anything that causes a capital gain, you can use this. It just has to be within, and this is, most cases within 180 days of when you realize the gain. So there are other exceptions, based on ownership structure and things like that. So feel free to reach out to us if you have any questions on the timeline, but just a very interesting tool. So basically, the first step is you defer the taxes through 2026. So you still end up paying taxes. It's just that it gets postponed for 7 years, or 6 years based off of our current date today. And then if you hold the fund, the Qualified Opportunity Zone Fund, for more than 5 years, you get a 10% reduction in the original tax owed. So if you owed $10,000 in taxes, you'd get 10% off that and only owe $9,000 in 2026. But and you can only use capital gains to invest. So if today I invested, if I had a capital gain of $100,000 and I was going to be taxed 10% on that, which is a low number, just using it for easy math, I would be able to defer that $10,000 till 2026, which I would then get a 10% discount in 2026 and then pay a check to the government in 2026 for $9,000. But that original $100,000, if I continue to leave that in the fund for 10 years, 10 years is the mark, any growth on that 100,000. So, you're investing in ground up real estate. So there's opportunity for, some positive gains. That 100,000 turns into, let's say, 250,000. That $150,000 of gains is completely tax free. So that's why a lot of people are very, excited and interested. And again, it's just like DSTs. It's got to be the right situation for you. It's illiquid, it's real estate, ground up development. So there's a lot of risks involved. So, it has to be the right situation. So again, we come in, we hear the situation, hear your story, what the gain's from, and then really kind of work with you to determine if it's something that's plausible or not for you for future gain. So this slide is just telling you qualified opportunity zone funds invest in qualified opportunity zones. So those tracks that I sent you in all 50 states, a fund will raise capital and then look to invest in, some of those areas depending on what they think, they follow job growth and population growth, things along those lines. Again, any U.S. taxpayer that recognizes capital gains for federal income tax purposes is eligible. Individuals, corporations, S corps, trusts, and again, feel free to reach out to us if you have a question on how your asset was titled, and we can certainly kind of give some guidance. Again, short-term gains, long-term gains, Section 1250 gains, security sales. There's a whole host. As long as it creates a capital gains, in most cases, it is eligible for the deferral, the reduction, and the ultimate elimination of capital gains based on all that criteria that I mentioned previously. All you have to do is let your accountant know. You technically can restate too. So if you're just finding about this today, and you've already put in your 2019 taxes because you invested at some point late last year, you are still able to restate, and you would be able to work through those capital gain pieces that you've already may have paid on. So your accountant just has to file a Form 8949 that lets the IRS know that you invested in a qualified opportunity zone fund. Similar to what Patty mentioned, some states are conforming in the 1031. All states are conforming except Pennsylvania, similar to opportunity zones. So all those states in green conform to this on a federal and state level, and the ones in the maroon color, including Massachusetts, including Pennsylvania, but the rest in New England and so forth are in green, conform only at the federal level. So you would still have to pay your state taxes as of today in those maroon states. And again, this is just a quick little diagram showing you that the deferral, the step up, and the elimination on taxes. So that's it. Again, I'm Sean Whalen from our New England office. I just want to mention Johannes Earnhardt is out of our Mid-Atlantic office as well. So he's not on today's call, but feel free to reach out to him if you have any questions in your area. But that being said, Alexandra, I'll toss it back to you, and we can open it up for questions. And again, if there's no questions, we're more than happy after the call to have people reach out to us and let us know how we can help.
Absolutely. Thank you so much. That was really, I think, precise and efficient use of time. So I really appreciate that. It was a lot of info, but well said. And also, I just put up a question on the screen. If you would like to schedule a consultation with Sean, you can certainly say yes here, and I'll go ahead and forward your info over to him. Some of you may have already answered that when you registered, but go ahead and put it here again anyway, so that I can make sure that you get contacted. And then also, if you have any questions, please put them in.
And for Patty as well. Patty's available. Oh, right. She knows everything and every detail about a 1031 exchange, so she's more than willing to help you. And she covers a wide swath of property in New England as well. And her company is national, so she can certainly connect you with the right QI from her company wherever you may be.
Okay, great. So I haven't seen any questions come through just yet, but I'll give you guys all just a little bit more time to put in any last minute questions you might have. And then also just a reminder as well that tomorrow I will be sending out the recording to everyone, so you will have access to this whole thing. So you can watch it as many times as you want, share it wherever you want. I'm sure that Patty and Sean would love that. And also, in terms of questions, I'll also send you Sean and Patty's contact info. So if you want to follow up with them, you can. I know it's on the screen here, but I'll also email it to you to make it easier.
Mm-hmm. Thank you. Great. All
right. So I don't see any questions coming through. It's probably because you guys did a great job of explaining everything.
Yeah, so thorough, huh?
So with that being said, I really appreciate you guys coming on the call and doing this and taking the time. really helpful, and especially the part about opportunity zones. I had no idea that was started by someone who's Facebook's related,
First president,
first president. Like
first president,
that is crazy. I've heard of opportunity zones, obviously, but I had no idea that's how it started, which kind of makes sense. So anyway, thank you all for joining the call, and we'll see you hopefully again soon. Take care.
Great,
Great,
thank you.
thanks so much.
Bye.
Bye-bye.